Welcome to the Gray Report. I'm your host, Spencer Gray. Got some exciting articles to cover related to the multifamily industry, residential real estate, in general, housing affordability. Really exciting piece from Yardi, CoreLogic, and Moody's Analytics on single-family rentals and affordability. Another piece from RealPage, also on affordability. We're looking at not only what the demand and growth is in the single-family rental market, but how renters across the nation are able to afford or not able to afford these single-family rentals. We're also going to be jumping into the Yardi Matrix, their national multifamily report, which also touches on single-family rentals, but just getting into where are we in the multifamily market after we've gone through a long period of general rent growth declines in a pretty soft multifamily market, especially in the Sun Belt. Been very different depending on which region you're in. The Midwest and Northeast have been outperforming. The Sun Belt and the West Coast really been dragging along. But I think we're starting to see some green shoots as spring approaches. You're going to want to pay attention to the whole episode. Make sure you're subscribed to the Gray Capital YouTube channel so you get updated. Stick around. Really exciting stuff. Let's just get into it. Welcome back to the report, joined again by Dr. Matt Bossnagle, Director of Communications and Marketing here at Gray Capital, producing the Gray Report. Also, Matt, you put together a really good selection of articles and data today. And one thing that I just mentioned is what will be absent from let's see if we can leave it out, is talk of interest rates. We talk about interest rates almost every week, and I don't think it was intentional. It will find its way in because obviously financing has driven a lot of the softness in a different way and created more uncertainty around the multifamily market. But we're going to be talking a little bit more about the fundamentals and what 2024 is starting to look like as we're still not yet in kind of peak leasing season, but we're starting to ramp up. So we're going to look at the Yardi Matrix report, but also we don't always talk about the single family rental side. And, you were just mentioning before the show, during the pandemic, we saw so much growth in that segment. Vacancy rates really plummeted, even more than multifamily, as folks were looking for more space than an apartment where they had been living, working from home. Matt, just before we kind of get into starting with the Yardi Matrix report, what are some of the takeaways, that you were seeing as you were getting ready for this episode? What made you kind of shift the focus on the single family rental side?
It's a topic that I don't think that we don't regularly talk about it, but it matched up a little bit with some of the arguments that we were hearing from a Bigger Pockets article that we discussed.
Yeah, that's right, last week.
And the argument was that more people, as millennials get older, they're going to want a home, they're going to want to rent a home, they're going to move out of their apartment, and they're going to rent a single family home.
Yeah.
And that's going to mean that apartment rents go down. That was the argument.
And, I think that's a really logical argument. I mean, because I think most people, if you ask someone if price was not an object, or was not an issue, would you live in an apartment or a single family home? I think most people would choose a single family home. Probably not all if you really want to live in an urban environment where that's just not an option. I want to live in New York City, so not saying me, but if someone wants to live in New York City, a single family home probably isn't going to be in the cards.
And then there's all the times, and I remember even us talking about it, like, oh yeah, you don't have a lawn to mow, but like, no. Probably rather have the lawn, even though you have to mow it. But that's where the single family rental comes into place. Yeah, exactly.
Because you can have the yard, and usually the landlord's not going to want you to mow the lawn because they don't want the tenant. They don't want to get fined by the city for the tenant not mowing the lawn. But it creates a potential best of both worlds is having, the American dream experience of having the backyard and the maybe a white picket fence for the dog and the family and everything.
Yeah.
But you don't have to go and put 20% down and get yourself into a 30-year mortgage, which has been kind of the bedrock of wealth creation in America.
Yeah.
But we've talked about it here on the report before, Matt. I think that perception is changing a little bit. Of it's more important that you start investing early on, whether that's in your own home that you live in,
Mhm.
or in stocks in public markets, or in income real estate. Like
Yeah.
multifamily apartments or industrial or whatever. It's more
Mhm.
important that you start investing and building that nest egg. Not the only way to do it is buying a house that you're gonna live in.
Yeah, yeah. And what you mentioned before, and you kind of explained it a little bit just now, and even before the show for a second, is like affordability is the ultimate is kind of the ultimate stop for some of these people. If you need housing and you can't afford a single family rental, then you're going to rent an apartment, or
Yeah.
you're going to find somewhere to rent
Well, that
that
was
meets your
my biggest
budget.
issue with the Bigger Pockets article, is that, and the point was, like you were saying, yes, the desire for single family homes is going to start eating into
Mhm.
multifamily demand. But one kind of housing demand is housing demand, first
Yeah.
off. But we have an affordability issue and crisis in this country, and so the scenario where there's a couple factors. One, where people can actually even afford to live in a single family rental, not even to buy a single family home, but renting out a house is always typically, unless you're like really out in the country somewhere, it's got to be more expensive than an apartment.
Mhm.
And so many of the decisions around housing is driven by what you can afford. And it's
Yep.
already, people are having a hard time affording apartments today. There's only such a large percentage of the population that can afford to live in single family rentals.
Mhm.
And then, on the other side of that, it goes back and forth between, depending, and this is driven by interest rates, but you're going to have competition of folks actually just buying single family homes.
Yeah.
And so whether
Yeah.
that's going to be, it's not a zero sum game, single family rentals and, multifamily. There's a couple different players
Yeah.
in the game.
And there is, and Yardi Matrix mentions it too, and I'll give the quote in just a second. But the interest of the investor class in single family rentals is has been raised a lot, but especially like by mainstream. I want to say
You
mainstream
mean
media.
the BlackRock,
Well, yeah, like
not
it's
BlackRock,
yeah, BlackRock, not BlackRock, Blackstone, whatever. The big
but corporations
yeah.
buying up single family homes,
Buying up the
and
house next door.
buying up the American dream
Yeah,
for
yeah.
Americans. Yeah.
And that's not that's a small sliver is happening, but like the balance between an investor and someone that wants to buy the home to live in, the investor is going to have a probably lower threshold than the person that's buying it to live in it. The way that they approach home buying is kind of driven by returns,
Yeah.
and at this point, the individual buyer, and you just look at the home prices versus rental prices. The home prices have kept going up and rental prices have not. And it just seems to be that there's an extra incentive for someone that wants that kind of emotional, want to buy the house, wants to live in it. They will maybe bid up investors.
Yeah. Yeah.
And if you thought about that as one, like not voting block, but one group of incentivized people, they vastly outnumber the investor class. And I'm not, trying to say that this isn't something to watch, for sure, but it's not an existential threat to the American way of life,
Yeah.
as it's
True.
sometimes portrayed.
Good point. Well, the other thing, Matt, and you touched on just briefly, is availability and the volume. So
Yeah.
even if you wanted to, whether you're Blackstone or if you're an individual looking to buy, there aren't that many homes that are on the market to
Mhm.
purchase. A lot of sellers don't want to sell because they're locked in incredibly low interest rates, and that's another kind of barrier to I guess a move away from rentals.
Yeah.
If affordability wasn't an issue, there's just not enough single family rentals
Yeah.
that are available, even if everybody could afford it and wanted to.
Mhm.
So there's a couple challenges there, but certainly we're going to see, and it's okay. We hit all the points of why single family homes aren't going to cannibalize multifamily, but at the same time, there is a growing demand for more space and
Mhm.
single family homes as millennials, are right in those kind of peak family
Yeah.
formation years. So I think the build to rent space, single family rentals are all great niches
Mhm.
to be in. They can be sometimes more difficult to finance and to scale, but if you can figure it out, and we've done some work looking into here at Great Capital, it's a worthwhile niche investment class to get into
Maybe can't
so
buy
early on.
Yeah. Maybe can't buy like 80 homes. Maybe you're a big company. You want to invest.
Yeah.
And you're like, oh, I'll just buy 80 homes in the city. Well, if they're all spread out in the city, it's going to be hard. You're gonna have a maintenance guy driving around all day helping people. But if you got a big plot of land and you build those 80 in one place, maybe it's a little bit more efficient.
And I don't think we didn't prepare this graph, man, unless you tell me if we've got it somewhere.
We don't.
But I remember seeing a chart during NMHC showing the amount of I think it was deliveries of kind of purpose-built BTR projects in the United States, and how we've basically gotten 3 to 4x the amount of deliveries of kind of purpose-built single-family rentals that we're delivering, nowadays versus a couple of years ago. So it's definitely ramping up, but it's still kind of a sliver and a drop in the bucket compared to the overall, what's being in the pipeline.
So it's not threatening, but I would say it's like it's more useful to look at it from an investor's perspective. Like, oh, that's an option for investors. Yeah. I don't think it should make existing asset holders, whether you're a homeowner or an apartment, an apartment owner, it shouldn't make you nervous.
Well, no, and I think I think it's an opportunity, and you have to just be on the edge of the curve to be able to offer the products that the customers are asking or looking for. I mean, that's the bottom line. I mean, I know that a lot of the deals that we're looking at and that we've bought in the past, we get really excited, and we look for projects that can provide at least a similar amount of amenities that a single family home, would provide, whether that's like townhome style units or units that have, direct access garages, larger floor side plans. So where you say, okay, well, maybe you share a wall with somebody, but you're still getting all the benefits. You've got your own place that you can park. You're not going to get snowed on. I mean, that's a big thing, just having a garage for some people.
Yeah.
We've seen a lot of developments, and we've looked into this also to build it's called like puppy porches, where it's like on the first floor units. If you've got a little patio, you can build a little like fence, kind of 10
just
by
like
10.
A little yard.
And you have AstroTurf, gravel underneath. And so, it's, relatively easy to clean. You don't have to get a mower in there.
Could you have a grass yard if you wanted?
Yeah, but you got to have
I'm a tenant. I'm a resident right now.
Yeah.
I'm asking you, can I put a yard in there? Or you're like, no, probably not.
No, but it's because it's hard for the landscaper to get in.
Okay.
And, you got to get in the trimmer in.
I'm gonna do one of those like wildlife. I'll have like a wildlife preserve with tall grasses.
Well, exactly. The turf makes it always look good. It's one less thing to maintain. But that's just another thing that you can do that you want to be ahead of understanding what tenants and residents, prospective residents want, and and whether that's like you got a cell phone reception. Like how many? I bet 80% of apartment buyers, when they go into a prospective acquisition, they're not looking at how good the cell phone reception is in the buildings and at the property. You'd assume that it would always be good, but if you don't have good cell phone reception, like how long are you going to live somewhere?
Yeah.
If your internet options aren't pretty decent, you're not going to be able to rent to kind of the core renters, which are 20 something, early 30 something, or then much older, but then really kind of 20s and 30 something. If you don't have really good internet, you don't have cell phone reception, you're talking to the wrong crowd.
Yeah. And I haven't discussed this, and I don't even have it in my notes, so I apologize if I'm going to stumble through this, but I think that a home is a big part of people's identity. And, that's kind of what got me excited about mowing a lawn and stuff. Or, you put a lawn in there, you make a garden in there, you do something that you want to live somewhere, and in a certain way, you're kind of showing off to other people. Look at my pretty lawn. Look at my nice house.
It's a lifestyle. Yes.
I'm the kind of person that lives in this
mornings, and you're fixing stuff up, and you're puttering around, and and
it's kind of like do we make houses or do we make living spaces available for people to live in where they're proud of, where they can kind of see themselves and show other people, like, I'm the person that lives in that house. That's a big part of home ownership. And when you're in a rental, you have less control. It's less of like, well, the front looks bad, but like I don't have control over it. And so it is interesting to see single family homes pop up in this way. And like, in my experience of owning a rental house is like, yeah, I mow the lawn, I cut the tall grass, and like we planted a little garden, and there, there's just a lot of lifestyle things that are accessible to people in a single family home that just can't. Maybe it's a life stage thing too, I think. But yeah, it's so much different. It's like a rich
Yeah.
experience.
I think it's a really good point in the questions, how do you offer, similar
Yeah.
opportunities for experiences to apartment residents?
Mhm.
There's things like community gardens and things like
Yeah.
that, where you can kind of have, give a similar level of kind of control over,
Mhm.
but it's kind of limited.
Yeah.
And I'm just, just spitballing and
Mhm.
brains turning. And it's like, you could almost even have like you wouldn't want to like actually, I mean, you could hire people, residents that live your property,
Mhm.
on a short-term basis, but even like an incentive program of like, hey, if you want to walk around and pick up trash and or do something, and
Yeah.
you can earn points that you can use to,
Yeah.
reduce your rent. Because some people like that. I mean,
Well,
some people are
and
like, well, I'm retired, but I kind of want to do something walking around. So pick up the garbage.
that's a very good point. So it's not even pick up the garbage. It's like, yeah, so your identity is as much, I live in this home, I live in this apartment, but I also live in this community.
Exactly.
If I'm walking my dog, so I'm back to my single family rental days. If I was walking my dog and my dog went to the bathroom, I picked it up. And do you do the same thing in the apartment community?
You're supposed to.
You're supposed to. You live in a single family home. You take your garbage cans out, you put them back. You
Yeah.
take your garbage bag and then put it in the dumpster.
A little bit
You
of
don't-
responsibility,
Yeah.
it
ways
that's
to
a sense of ownership and pride.
Yeah, exactly. And ways to really, and this is dipping into my academic life, but really like, you don't want to be a bad neighbor. People will not like you if you're a bad homeowner. If you have this bad relationship with your home and your community, they're not going to like you.
Yeah.
And so I don't know if there's a way to like enforce that social, but it's the importance of the community and the responsibility that you share it. So there's ways to build it.
The community building can be the ultimate, value add.
Yeah.
That is easy to say, very hard to do,
Mhm.
can't happen overnight, but it can be really strong because when you
Mhm.
increase that retention in that community, you continue to further demand. It's hard to replace when if you stay 96, 97% occupied.
Yeah.
You can actually push your rents on because you have very limited availability.
Mhm.
And, because you're probably not going to be able to get as much growth on the renewal side, but still you can push some of your market rents even further.
Yeah.
And it all adds up tangibly and more abstractly. Matt,
Yeah.
let's get into this Yardi Matrix
For sure.
report. And Matt was concerned that this may be a shorter episode today, and I said, Matt, don't worry.
We'll
I
figure it out.
said, just let me take care of that. We'll get into all kinds of off topics. All right, National Multifamily Report. What market do we have here, Matt? Where is this?
Maybe that's Columbus.
That looks kind of like
It should be Columbus. I've been hearing everything about Columbus in the past like month, really.
Yeah.
Their population growth, job growth, their rent growth. There's really nothing not to like about that.
People are talking about the Midwest, Matt,
Yeah.
a lot. So just first 3 bullet points: ongoing strong demand is keeping U.S. multifamily rents steady, even as supply growth exerts downward pressure. The U.S. asking net rent was unchanged in January at $1,710, while year-over-year rent growth rose 10 basis points to 0.5%. So we've got a little bit of growth year over year. Now, that's to note because, there were some decline. Again, we got a base effect coming in. Rents were had already dropped. So, we're not necessarily, positive from, the peak, but, certainly starting to trend the other direction.
Yeah.
Second point, the Northeast and Midwest continue to outperform in the short term. Demand is created by the strong economy and job growth, while large urban markets are benefiting from 2 years of high immigration flows. Matt, we should do a whole episode, or at least cover. I would like to see more research on the impact of immigration, legal and illegal, over the last several years. Because, if you've been, pay attention to cable news, a lot of talk about, immigration into this country. Take the politics or the, the good and the bad, out of that. It's a lot more people in the United States. We need more people in the United States, whether that's increasing the natural the birth rate to otherwise would be a declining population.
Yeah.
So again, taking politics and your morale, whatever, taking that out, it's, positive immigration is a good sign for multifamily and housing. And there's probably millions of people that have come into this country. And so I'd really be curious on a study on what that impact is to different markets and their impact on those housing markets.
Yeah. It's like a very strident and critical issue.
Well,
but I also think that there's
studies,
so many ways to look at it.
There's a lot of different ways to look at it. But I mean, I remember going back, over a decade, there's a lot of research showing that, immigration was basically the driver of still positive population growth in the United States. And so if immigration declines or increases, that's the difference between positive or negative U.S. population growth. And then obviously some cities and metros are more sensitive to, immigrant inflows. Yeah, I just like to look agnostically what the effect would be. But anyway, single family rental performance remains robust. U.S. average single family rents rose $2 in January to $2,130, while year-over-year growth rose 20 basis points to 1.5%. 7 of the top 13 metros for rent growth are in the Midwest.
For single family rent now.
For single family.
It's even more out of balance. I mean, it's even more favors the Midwest and Northeast when it comes to apartment rents. I just want to go over these top markets here for the for year-over-year rent growth. New York City is at the top, and New Jersey. These are, and then there's Boston that's in that list too, as well as Philly and Washington D.C. But plenty of Midwestern cities like Columbus, Kansas City, Indianapolis, Chicago, Minneapolis, St. Paul, Detroit. All of these really doing quite well, and it's only really San Diego that's the only Sunbelt city that is above average among all these apartment markets when it comes to year-over-year rent growth.
Another supply, and San Diego is technically Sunbelt, but very different dynamics in California than in Atlanta or Phoenix or Austin. Yeah, for sure. Yeah, and then just also New York City saw a significant rent declines several years ago,
and that's exactly I think so too. And it's like, and for New York City, I don't think the supply is the story or like lack thereof. I think that it is just the reaction of the lackluster rent growth and people like they said in this report, people kind of returning a little bit to the large urban centers. Maybe not immigration, but just emigration. Is that when people migrate?
Emigrate?
Versus immigrate.
Like the E or an I?
Yeah.
Just making
whatever. But people are leaving and coming into New York City, and maybe it is a kind of reaction.
Just say move to.
Yeah, move to. Yeah, I'm not going to confuse myself. But the month over month is very similar to the year over year, actually, in this, at least in this case, with a lot of Midwestern cities also sharing the top spots. Columbus, Indianapolis, Twin Cities, LA actually popped up when it comes a little bit more Sun Belts in the month over month, but month over month is a little more volatile in general. So it's not going to be clearly regionally delineated as the year over year was.
Yeah.
Average rent growth, it was up 0.1% for the nation last month. And that is promising. And you touched on it a little bit. I think that we are starting to pull up. The plane's pulling up. The blood has been staunched. The losses have been, have been stopped. We are in the positive territory. And if you even just look at the chart, it seems like, there was a clear dip. And now we are a little bit flattening, and all signs point to it raising. It would be
and this is pre leasing season too, also. Matt, interesting, San Diego, while doing pretty well year over year, month over month, they're seeing the most declines.
Yeah. No, that was good. That's a good note.
Yeah.
Wow.
So and then a rent renewal growth, this has been, interesting. This is still in multifamily, not single family. Kansas City seeing really strong year-over-year renewal rent growth, 9.5% monthly lease renewal rate, 71% really strong. Similar kind of folks you'll see on the list, Miami, Portland, San Diego, Philly, New Jersey, Indy, Boston, all kind of take those top slots of renewal increases.
So is renewal rent growth essentially like this is how much rent growth was last year?
No. Renewals are you're renewing your leases.
Yeah.
So like you got a lease for a year, and your lease is expiring, and your rent's going up $25, $100. What are
Yeah,
those?
yeah.
What are those increases? You're typically not bringing your renewals all the way to market,
Okay.
and so you treat your renewals differently than your new marketed rents.
That's what I was wondering, if the renewal rent growth, how much of a lag is it between, how much is it lagging behind the previous performance? And our renewal, like Indianapolis, for instance, 6.9 renewal rent growth, but the actual rent growth is closer to 3.
On new leases.
For new leases. Why is it so high for renewals?
Because some of your renewals will be significantly under market.
So they're catching up basically.
Yeah, they're catching up.
Yeah,
so
okay,
let's say rents have moved
so
to
lagging a little.
So let's say your market rents are $200 below. You've got a lease coming up. It's on a long-term tenant. Maybe they didn't get a rent up last year. Or something. Say it's a new acquisition. Your new market rents are $200 below where their rent is. You raise the rent $200, they're going to move out. You don't necessarily want them to move out.
So you spread that.
Yeah, you make it more moderate to retain occupancy, because it's always a balance of occupancy and rent growth.
Yeah.
And trying to find a balance of really positive kind of economic vacancy and NOI growth in general.
Yeah.
And so if you try to it depends on the market. During COVID, when we had retention rates in the 60 to 70% range, and units were, we were 98, 99% occupied. We didn't have any units to lease. What the strategy was, all the renewals were going up to market, or most of the renewals were going up to market, because we'd be leaving so much money on the table, because and sometimes we had wait lists. We had prospects saying, I'll pay the new rent of $1,500. We've got the old lease at $1,300, and so we're telling the current resident, like, look, we've got a wait list for your unit. The people are willing to pay $1,500. We very much appreciate your business and you being here, but we have to make a business decision if the market is demanding the new rent.
Isn't there some crazy math that people do where they charge renewals sometimes higher than new units?
Yeah, your inverted growth. So if like on your new, if you're increasing renewals, but you have to pull your market rents down, which happens sometime. Some of your market rents, you maybe gotten a handful, but you're like, oh, all of a sudden there's a lot of weakness. Vacancy is increasing.
What's the
you need to basically kind of get some heads in beds, and so all of a sudden you're lowering your market rents, but you're still able to get some decent renewals.
Is there like
or you're renewing people with no increase?
Yeah, but
you're having to lower your actual market rents.
Okay.
Below. I mean, so let's say someone in Austin signed a lease, in 22 or 23 at $2,000 a month, and all of a sudden that property's gone set to be 75% occupied, so they've dropped their market rents to $1,800. Well, on that renewal, you're trying to still get the $2,000. Maybe they'll push, be like, hey, I saw you lowered your market rents.
Yeah.
So maybe you renew at $1,900, but your renewals are still higher than your market
I thought
rents.
that there was maybe like some shenanigans with how, if you get renewals, if you make the numbers work right for like the value of the asset or something like that, to mess with renewals in some way. Now, I just thought there was maybe an element of shenanigans in this, unless like the
renewal strategy is really important.
Yeah.
I mean, sometimes you're trying to like balance your expiration schedule, like on your leases, but I don't really know what you're talking about.
All right. I thought, well, I'll have to
in terms of shenanigans.
Well, I mean, there's stories of people that, just move right down the hallway and save money on their rents because it makes it.
Well, if there's a concession going on, a resident would be like, demand, okay, give me that concession for a new lease or something like that. But okay, let's look at let's get into some of the single family home stuff, Matt. We keep teasing single supply, demand, and demographics.
Yep.
Affordable single family rentals increase share of supply pipeline.
Yeah. Single family rent growth, 1.5% rent growth year over year for January. It's up 0.2% from December. I'm just going to read this whole article because it touches on this institutional thing here. The growth of the institutional investor single family rental segment has slowed as rising interest rates and low for sale home inventory have reduced scattered site acquisitions. However, private equity giant Blackstone made a big vote of confidence in the sector recently by reaching an agreement to buy Tricon Residential.
Which ended up being more confusing. Blackstone or BlackRock? Blackstone?
This is Blackstone,
Oh,
that it
okay.
says.
I got the right one. I got the right one.
Yeah. So Blackstone already owns 17,000. They are buying this Toronto-based REIT that owns 36,000 in the U.S. and Canada. And so it's also buying Tricon's development pipeline, which encompasses $1 billion of build-to-rent homes and 2.5 in Canada. Wall Street says that Blackstone can also increase earnings by implementing more efficient property management procedures. You know, that's something that we've seen in the apartment market, and you've talked about specifically too, is, you know, it becomes more efficient, and as long as, you know, this kind of standard of living is the same, and people are still getting the same amount of service, then yeah, reducing scattered site acquisitions. If the maintenance guy doesn't have to run across the whole city, then that's great. Put them all in one place. The people are still being helped at the same, and then you're just the people are being helped at the same rate, and you're just saving money. But
great points.
But I also want to have this caveat. It's like, this is definitely still a small sliver of the market. We're talking about 36,000 plus 7. Even if you include all 36,000, which are mixed between U.S. and Canada, 36 plus 17,000. What are we? Like, let's just, even if it's 80,000 single family rentals, that's not a lot of things
for across the nation. Yeah, it's a real drop in the bucket.
Yeah.
Now I don't know if that's including. They're just talking about communities 50 homes or larger.
Oh, okay.
It's probably they're not talking about every house for rent.
Okay.
So they're more talking about things that are really kind of managed.
I thought they were talking about units.
I mean, I could be. Sorry, for the what the Tricon has in their portfolio. Yeah, they've got 36,000. Sorry, I thought we were talking about the whole market.
Yeah, it was just.
Yeah, but that's not, again, compared to the whole market, that's still a relatively, I mean, they would, if those are multifamily units, you know, they would be a big owner, but they're not the.
And if it was all in one market, that's huge. But if it's spread across two nations, maybe a little less. But again, look at the opportunity here. These guys are noticing, and you know, I'm waiting for someone to make it work where they can buy scattered across the.
Blackstone has done that in the past. I mean, after the Great Financial Crisis, they did a lot of that, and then they've
or like even if it's within like a square, you know, a certain neighborhood where you're and then you have, you know, then one maintenance guy can walk to all of them or something. But you know, having to drive from Fishers to Mooresville.
But you know, you talk to Katrina, she'll tell you that managing a single family home is a little bit different than a multifamily because the single family renters usually demand a little bit less because there's that acknowledgement that it's like kind of my home. Not that they're supposed to be fixing everything themselves by any means, but you're like typically not getting
ethos.
The like, hey, I'm going to call the maintenance guy to because I've got a light bulb that's out.
Okay,
it's a generalization, but
no. That's there was one time I left the garage door open, and for some reason, the single family rental that I was renting, they had their water heater in the garage, and it was like sub-zero temperatures. And so the pipes froze. It was a small trickle, so we warmed things up, and then it started a big spray, and I just blindly reached back and turned that water off, and then I called the property manager.
You are a good resident.
But you know, there's other times where I wonder how much. Again, it's like this lifestyle and this identity thing. You stick them in a house, maybe they start fixing things a little bit more than an apartment. They see themselves as different.
Yeah, I think it's a lot of the small things that you just don't avoid. I think. Okay, rent to income ratios. So we're going to talk about affordability today, Matt. Also, it's obviously always a hot topic, you know, and fortunately, wages, as we will see a little bit later on a Moody's piece, in a RealPage piece, incomes are growing faster than rents in 2023, and they almost certainly will grow faster than rents in 2024,
which aligns with the Moody's piece.
So let's look at who is the most rent burdened. Well, it's Central New Jersey. They're getting out of, high priced New York, and it's still expensive in Jersey as well. Followed by Washington, D.C., Baltimore, New York, San Diego. Wow, man. All markets that have a lot of local government intervention and rent control. Now then it's Nashville, which is just seeing a huge apartment boom. Orlando, Tampa, Boston, Denver, Portland, San Francisco, LA, Twin Cities, Philly, Chicago, Atlanta, Miami. These are all markets that are relatively cost burden, especially in the renters by necessity. Just a reminder, it's typically assumed that 30% rent income ratio is at the level of where housing becomes affordability, or you are a cost burden renter. And so with New Jersey at 35.6%, that's pretty high. And then on all of their units, combining between lifestyle and renters by necessity, it's 37.9%. The lifestyle units, people are really, this is crazy. People are stretching well beyond their means in central New Jersey, having on an average 43.6% of their income going to rent. That's just on average.
I think that this skews much higher than the numbers from either RealPage or Moody's Analytics. Now, they don't have an average here, but just looking at all of these and glancing at them, it's pretty close to 30 here. And it seems like it is above what we're seeing. Now, I don't know where they're taking their data. It says all units sorted for highest to lowest, source Yardi system screening data. It definitely seems higher than it's very clearly higher than RealPage and CoreLogic. CoreLogic is it's also the same. But what is interesting, the breakdown for lifestyle and renters by necessity, it's not always so clear. Renters by necessity are paying less than lifestyle units when you're coming to rent to income in New Jersey. But if you're in Washington, D.C., then the reverse is true. It does seem like in general, renters by necessity are paying more as a percentage of their income as renters by choice.
Yeah, let's look at the bottom of the list, Matt. Kansas City's one of the more affordable, larger markets. 25.7% across all units is the average rent to income ratio. Austin, 25.9%. In Indianapolis, right at 26% average rent to income ratio. So, again, you want to be looking at some of these markets below 30%. Here's also interesting, Matt. Northern New Jersey, it's the opposite as well, with 40% of renters by necessity being rent burdened, whereas only 26 is lifestyle units. So
this was weirder.
And Austin is near the bottom of the list also, by the way.
Yeah, I'm a little bit unclear about this list, less than the one that they have in the following pages or amongst the following pages of rent growth and supply and their forecast for supply for Yardi Matrix. I really like that one because it's a clear, all right, these are the percentages that they're building, and the rent to income, I just don't know. I don't know. It just doesn't agree with the other numbers. And so I'm a little more skeptical of the Yardi Matrix figures here.
Yeah, they are what they are.
Yep.
There's usually a bit of difference between, especially comparing Yardi to RealPage. We're looking at supply dynamics. We talked about that as well.
That's what, I'd love to look just really quick for the Yardi Matrix, their ranking of the supply, basically the percentage of supply. I think that's the most useful. And a lot of times we only get the raw number of units built. But the only thing I really care about if I'm looking at a market is the percentage of current units are, new.
So let's look at, all right, I'm looking at completions as a percent of total stock. That's, how much inventory is coming in. New York's always pretty low because they just have such a big stock. And these numbers, Matt, are low, which means that, completions are slowing down, or it depends on, what's under construction as a percentage of inventory also, which is different from completions. Because we're seeing a lot more lower single digit numbers. There's still a lot in the pipeline, but slowing down.
I'm also assuming that this is a yearly number. So it's like a rolling.
Yes.
From January 23rd to January. And it is quite interesting on the whole how much things have dropped, a little bit. I don't know if this is what this portends for 2024. But I could easily see the supply not being quite as much of a deluge as it was in 23.
Yeah, I think that's a good
But
Good point.
it is, all of these. So it's New York City, New Jersey, Columbus, Kansas City, Indianapolis, Chicago, Boston. It's the same Midwest. And I'm thinking that they're ranking this according to their forecasted rent growth as well. So they're, what? I thought that they had a forecast. Never mind. I'm sorry.
Well, they do.
Oh, yeah.
I think they have the forecast rent growth in this second column.
Okay. So they're ranking it over by the year-over-year rent growth, but they also include their forecast. So for New York City, their forecast is 1.4. New Jersey 1.8, Columbus 2.4, 2.2 Kansas City, 2.3 Indianapolis. Not so bad.
No. And then also looking at the job growth numbers, your 6-month moving average. Again, because this can be a really good leading indicator for population growth and then rent growth. New York City is about 2%, New Jersey 2.3, Columbus a little bit lower, smaller than you'd think, 0.8, Kansas City 2.4, Indy 2.5. A lot of some of the highest growth markets in terms of job growth, or you would be like a Dallas at 4.1, Vegas 4.1, Raleigh 3.5. I think Charlotte.
Can you scroll down to the bottom? And this is a really illustrative of the strength of the supply. Now, if job market is such an important thing to rent growth, and I do think so, it is striking that the job growth of all these bottom markets, Raleigh, Nashville, Orlando, Phoenix, Austin, are at or near 4 or 5%. Austin's at 4.6 job growth, but its yearly rent growth -6%.
Well, no, this is 4.6 of completions relative to inventory.
Oh my gosh!
Yeah. But I mean, similar point. So they've got a lot of supply coming online, 4.6% of inventory, and negative rent growth. And then 3.2% job growth and forecasting 0.9%.
Okay, yeah. So they're really covering they're closing in on 3% for their job growth numbers.
Yeah.
But the places with the jobs are the places where they built the apartments, and it's also the places where rents aren't performing very well. But I think long term,
I think that's much
never
more
count them out.
Yeah. Oh yeah, 100%. Those mostly short term problems that can get people caught.
Yeah.
As the music stops, but music's gonna play once again, and there will be more seats than players at some point.
Yes.
Okay, Matt. Then we're ready just to hop on CoreLogic, or no? Let's look at let's do the full thing. People are here. They want the meat and the potatoes, as well as the parsley and the whatever
parsley.
Occupancy in classes, lifestyle, and overall. We've seen occupancy decline. Look, starting this graph of March of 23, kind of just above 95%. On average, the country, we're basically kind of 94.5-ish, with the lifestyle being on the lower end, the renter by necessity being a little bit higher. But in general, we've definitely seen some softness. The question is, Matt, as rents are stabilizing, does that also mean that occupancy and vacancy will stabilize? I would say at some point, but we got a lot of supply to get through first.
Yeah. Other places like Apartment List have shown, and I think also RealPage have shown kind of a plateauing. I don't want to say it's a bottoming of the apartment demand, but it's definitely not declining like it has. It's fairly flat, and there is definitely room for occupancy to bump up a little bit.
Yeah. Yep, I agree. All right, well, now let's go over this CoreLogic piece, Matt. If that
oh yeah, so you talked about the squeeze and maybe not enough houses some places. I want to talk a little bit about their listing of single family rentals. Now this is completely dedicated, this report, to single family rentals. And it's a little bit lagging. So these are the December numbers. And they don't track it, I guess, as closely or as up to date as the RD Matrix, but their numbers are slightly different and worth mentioning. So CoreLogic also does a home value, like if for home buyers, and they do that with the Case Shiller. So this is them with the rental, the rental market. Their number is that rent growth single family is up 2.8% year over year. Now that compares to the RD Matrix number of 1.5%. Again, that's December's number, but it does show markedly stronger rent growth for single family than for apartments. I think that that kind of makes sense. There was less to kind of react to. I wonder if
we've only built so many new single family rentals. As we've said, it's been kind of a drop in the bucket versus new multifamily rentals.
And I think that totally explains it. I want to pull out here. So they have these markets ranked by the ones that have performed the biggest, ones that performed not the biggest when it comes to rent growth. San Francisco posted the largest year-over-year rent growth gain for single-family rentals at 6.2%. Despite that metro's area's recent, really like high-profile tech company layoffs, steep rental costs, a median of about $4,900 per month in November, growth trends continue to indicate that at least some rents are slowly migrating back to more expensive coastal metro areas. That's a quote from the article here. This is quite different from the San Francisco apartment market that we have known and maybe not loved, but pitied.
That's a good way to say it.
They were. I used to talk about the story of all these markets during the pandemic and how Midwest was steady and how Sunbelt rose and fall, and in New York fell and then rose like what we're seeing now. San Francisco fell, stayed down.
Stumbled.
And it's try to get up. Yes,
rolled, rolled in the dirt.
So it's very surprising to see these single family numbers. I don't know, Eve. I'm not very confident at all that this will bleed into the apartment market just because of the wacky zoning and regulation and the kinds of rules about what gets built in San Francisco. But at the same time, even though I have little desire to mount an argument against the vocal billionaires who now see San Francisco as little more than a loose confederation of shoplifting gangs and homeless encampments, but at the risk of angering some of these wealthy venture capitalists, I will say that San Francisco's still a city and it's going to be around for a while. And there are a lot of people with money who really, really, really want to live in a house there. So not only is San Francisco the highest in single-family rent growth, it also has the highest in single-family rents among all the markets listed. A lot of the apartment story or the explanation was, well, there's not rent growth because apartment rents in San Francisco is already, heads and tails above everyone else. Well, for this one, it's heads and tails, but it's growing even more. Maybe the interest in the single-family rental San Francisco market is due to tech executives decamping to Austin with Elon Musk. And
that's definitely it.
But maybe also the population in San Francisco just has some shifting housing preferences and the local makeup of housing availability. And like I said, the regulatory realities of the city make it difficult to find an apartment or meet the needs of people that are looking for an apartment. That's what that explains it a little bit. But I think what it from the outset, it is an image of a city that is not out by any chance. There's a lot of money and a lot of people want to still live in San Francisco.
In the Bay Area in general. No, there's still a lot of jobs, a lot of big companies, and obviously a lot of problems. But as you said, Matt, it is still a city.
But it's still not quite yet a loose confederation. But on the other end of the single-family rental market is Austin, Phoenix, Miami, and Atlanta. Midwestern markets are in the middle of the pack here, according to CoreLogic. And overall, they expect rent growth to be in the 2 to 4% range for single-family rentals.
Got it.
Fairly normal. I think it's subject to a little bit of the same pressures that have impacted the apartment market in that they're not predicting another year of really huge rent growth. Maybe more normal.
It's gonna be interesting. I think it'll be a very telling leasing season because I think everyone is a little gun shy to make any projections of strong growth. And not that there's a lot of I think there is actually some signs that we could see more growth than we're anticipating. I think the fact that the strength of the overall economy and job market keeps surprising, translates into rent growth. Also, then again, immigration, migration. I don't think that we're really tracking that. And I don't really think that we are kind of quantifying those impacts. And again, it's not going to move maybe every market, but they will move some markets and probably help some Sunbelt markets. But I think there is a chance for more growth this season because again, and taking anecdotes from our portfolio that we're seeing some strong leasing early on. The Yardi Matrix, early signs of strong growth early on in the year. It could be set up for kind of exceeding some of these forecasts. We'll see. But
there's room to be optimistic. And even what I would be interested in is looking long term in the next 5 years and what the single family rent growth story is going to look like compared to apartment rents and and if there is a divergence, or how developers are going to meet the needs of these single family rentals, and maybe investors like Blackstone, and make kind of an efficient system where the parity will get a little closer to parity.
Yeah. Yep.
I don't know.
Okay, now on to this real page piece, Matt. Another one from Jay Parsons. And we mentioned this. We're going back to affordability, but incomes grew faster than rents in 2023, and I believe Real Page's stance on this, hearing from Carl Whitaker, is that we almost certainly will see that same case coming true in 2024 as well.
Yeah, general trend is a decline. Now you look at their graph here, you see a bump up from Q3 2023 to Q4 2023, but they're going to take it from the peak to the to close to that to show the general trend down. And I also think that it speaks to the a little bit of volatility in the rent to income numbers. It's never a clear shot upward or downward. But it is worth mentioning, you see a big increase in rent to income ratio pre-pandemic. So from Q3 2019 to Q4 2019, the rent to income ratio spiked. Looks like it spiked more than it did in the for one quarter, more than it did between Q3 21 and Q4 21.
Yeah, well, and that's the we were seeing strong demand prior to the pandemic, which was interesting. There was a little bit more of a time of uncertainty, but we saw it, in the macroeconomy also. I mean, again, the yield curve was inverted. There's a lot of things that we were all kind of anticipating a recession that we ended up having a recession, just not the recession that we thought we were going to have.
And their number, though, ultimately now is 22.9%. That's the rent to income. So people are, according to RealPage, spending 22.9% of their income on average on their rent. Now, we've questioned the difference between RealPage's calculations because they have 22.9. There is no city in Yardi Matrix's list that has 22.9.
Yeah.
I think maybe RealPage anticipated that, or they're talking about other measures. I think that they're not necessarily looking at Yardi Matrix. They are looking at the articles that we have seen, and we saw them written all last year and the year before.
Well, RealPage is looking at their own. I mean, they're both RealPage and Yardi Matrix. The reason why we look at this data is because, or they're these two companies, but these reports is they have their own proprietary data.
Yeah,
because they both are software companies providing property management, and also pricing software, rental revenue management, pricing management software. And so they've got a lot of data around where rents are. They're processing applications and leases, so they know where incomes are as well. So that but they're obviously it's two different sets of data, because you got RealPage clients and properties, and you've got Yardi clients and properties. And I don't know what it's inherently not same store. It's different store.
Yeah.
And I'd be curious if anyone's ever done a breakdown. I'm sure Yardi and RealPage could, is, what, do RealPages, are they concentrated? And I don't think that there's, any regional or market concentration for either one, but I'd be curious if there were any difference in the kind of the different cohort groups.
Yeah, and like if they do anything to true up to make it a representative population,
and any assumptions made on any gaps in the data. Yeah, good point.
But regardless of that argument, it's like it is worth reporting that they have their number at close to 23. Yardi's is closer to maybe 28. Charitably,
that's it. The big difference.
RealPage does talk about their differences. I don't think they're talking about the Yardi Matrix thing. I think they're talking about the articles that we often read, that we often read last year and the year before about housing so unaffordable.
Just generally rents being more expensive. And you can see, on this chart, what as a layperson you would believe that, because your frame of reference is 2019. And so, it still seems more expensive.
I haven't forgotten it.
No. And it's like, just because I saw a price during 2021 that was ridiculous doesn't mean that my still expensive apartment doesn't feel that more expensive than it was a couple of years ago, because it was.
Rent is too damn high. That was a presidential campaign slogan. That crazy guy. The rent is too damn high party?
No.
Well, that was during the not during the Great Recession, but like 5-10 years ago, there was a guy, his party platform was the rent is too damn high. And, you know,
What party was
it's the rent is too damn high party.
Oh, okay. Yeah, maybe I did not
Well,
catch
needless
this.
to say, I'm sure that that situation, if that situation was true there's always going to be some people that say that. And it's always going to be true for a certain market where rent is higher maybe than other
people always
people's.
want rent to be lower.
I do want to talk about, so this real page says, other measures of rent to income, this is a quote here. Other measures routinely inflate rent to income ratios due to poor methodologies. You can't just mesh together incomes and rents from different data sets as most researchers do, particularly when you do this with public data sets on income. It's apples and oranges. This is because there are, unfortunately, millions of households who cannot afford market rate rentals. If you include them in the calculation, it inflates the ratio. It's totally valid to point out unaffordability among low-income households, but it's not an accurate representation of who actually lives in these rentals and the rents they're actually paying.
That's a good point.
I kind of disagree that the combined number is inaccurate in and of itself. It's more like the CPI versus the numbers you get from RealPage.
It's just a different
it's just like this
data.
but it is definitely worth like
noting,
distinguishing these two, and like, okay, you can have two different
numbers.
numbers.
A survey of every type of and again, the types of properties are going to be managed by a property manager utilizing RealPage or Yardi definitely falls into a certain type of large apartment community, not your 12 unit or 6 unit or duplex or even 50 unit property that's managed by a smaller property management company typically that is using, like, I don't know, a Resman or some other niche that's usually a little bit more affordable and doesn't have all the bells and whistles that you need to manage a 250 unit apartment community.
Yeah. And also when we're talking, if you're lumping in, this is the implication here is RealPage is saying you're lumping in affordable housing people with our market rate. We only have market rate. That's our clean number. But and I would argue that, I guess, if you're lumping in affordable housing, that is already a system in which, rents can exceed a certain percentage of area incomes.
Yeah.
There are rules that link together income and rents in such a way for affordable housing that almost makes it seem like an easy thing to solve for, or like they're already thinking about that.
You should you're having to verify. You're doing verifying incomes on a yearly basis.
So it is. I'm glad that they noted that. And the story, though, and I'm sure you see this even maybe in the affordable sectors, like rent to incomes, they're declining. Things are getting more affordable, or at least in trending in that direction.
Well, on that topic, Matt, this piece from Moody's, Q4 2023, housing affordability update, rent burden lightened for median U.S. households last year, but not everyone felt the relief. Okay,
so that may be what I was kind of getting at is it all the RealPage people that got the relief, or is it or is it everyone that saw a little bit of relief? The takeaways is that it's moderated since it peaked in 2022 at close to 30%, and now it's like clearly lower, but it's still, there's a bifurcation. So it says moderate and low income households enjoyed an above average boost to incomes, particularly in 2022. However, their rent burden improved little. Marginal dollars does not appear to be enough to offset increases in rents. Even in the more affordable segment of the housing market, it is interesting that I'd wonder if all these are market rate too.
So and it's a lot of commingling of data. So if your rent increased, if your income increased by, let's say 5%, but your rent increased by 15%, you're gonna feel that pretty hard. But if the data is commingling the Class A product that may have seen a rent decline or the rent's flat, and so you're looking at, the average market rent in that market actually was flat. That individual's income rose. Well, again, you're commingling different pieces of data and showing that those renters, their rent to income ratio drop, but you're not actually looking at their rent to income ratio. You're looking at their income and then taking the broader market, which I think we run into those issues sometimes.
Yeah, I was just scrolling through this thing, and they have a lot of great charts here that break down, the time element of these rent credits, so you can kind of see the story of how much rents have grown relative to incomes. But also here, it's a good reminder to compare this the cost of renting and the cost of mortgage payment. Yeah, it could very well be the case that rent is very unaffordable. But that is the story of the housing market, and that has been the story of the housing market since really the beginning of the pandemic. Um, it seems as if at this point, mortgage payments are really getting a lot higher than market rents, and it seemed to have crossed specifically. Now, even with the rent growth, rents were still cheaper in 2020 than mortgage payments, and now they are much more expensive, or not much more expensive, but they crossed that threshold in the middle of 2022. And I hate to say interest rates, but that could be
yeah,
that could
yeah.
be a
I
big
mean, it
factor.
has something to do with it. And so the question is, do single family home values come down to meet rents,
Mhm.
or do rents come to meet single family home
Yeah.
values? What does that reversion look like? Because, looking at that, I mean, you could see rents and single family homes decline, in
Mhm.
a deep recessionary type environment. But it begs the question that, on one hand, rents seem to be expensive,
Mhm.
regardless of what, someone may say from a rent to income ratio. Let's just say just rents seem anecdotally, ask 9 out of 10 people say, how much can people afford?
Mhm.
But then when you look at the difference between what it costs for a mortgage versus a rental, you'd make the conclusion that spread should be a little bit narrower. And if it's hard for the single family home values to come down due
Mhm.
to volume,
Mhm.
well then, and if there's eventually going to be some supply constraints in multifamily in 2 years,
Yeah.
you come to the conclusion that you're going to see some further rent increases.
Yeah. Yeah. I think that that there's definitely room when you look at the amount of income growth that we have seen, which is been all over the economy. Now I have
Yeah.
this chart up here that shows how the rent to income is dipping, and also guess what has been dipping as incomes have been going up? Rents.
Rents. Yeah. So you get a double whammy.
So this is a great story. It's a story that, from the perspective of a renter, this should be good news. I'm not going to like sing it from the mountaintops, because people are still remembering when their rents, like you said before, that you know.
But it's an obviously softer market. There are
Mhm.
concessions, there are deals out there though.
Yeah,
So
yeah.
for a renter, yeah, you're not getting a steal, but you don't feel like you're maybe getting screwed over, because
Mhm.
at least you're maybe getting like a month free or like $1,000
Yeah.
gift card or something like that.
And the housing sentiment index last month or so, the Fannie Mae had their recent numbers, and it showed, for the first time in a while, even people buying a home, they feel a little bit better about it.
That's good.
I don't know if it's a general consumer sentiment kind of thing, but it
Well,
definitely
interest
seems
rates,
like.
are definitely mention interest rates again, but they're definitely lower. I mean, obviously the 10 years creeped up a little bit in the last several weeks, but
Yeah.
compared to the middle of the summer, things are much better. It's not like
Yeah, yeah.
the 10 years at 5%.
Yeah.
Okay. Joint Center for Housing
Oh, that was
Studies.
that's just a little
Oh, is
figure that I
is this
had
a
here. It's an
bonus?
old, yeah, it's a bonus chart here. It's an old article that shows the share of renter households for
Yeah.
how many people are renting single family rentals versus owning. And you can see that clearly there were more people, as a share of households, there were more people renting single family homes in 2017 than there was in 2021. So it kind of puts the lie to that fact that, oh, all the homes are gone and now everyone's renting. Well, not quite.
Yeah.
That's not quite the story. But that's, and I reference that, it's like I'd like to see the numbers for 22 and 23, but it is a clear, you get to get all of 2021 when the housing market was as hot as ever. It's interesting to see that rentals still were relatively low compared to Tom.
Yeah.
2017.
Well, Matt, this has been a really good episode. I think a little bit of a different topic, looking at the single family home sector. also affordability, how it all fits in with multifamily. If you got any value out of this, you'd like to see more of this, leave a comment. Make sure you subscribe to the Great Capital YouTube channel. Oh, and by the way, if you're a accredited investor, you're looking at new opportunities to allocate into strong multifamily opportunities, Great Capital, we do have a project under contract, River Club Apartments. Check it out on our website, greatcapitalllc.com. Love to have a conversation with you, talk about the deal. Also, if you're on this YouTube channel, if you go to the go to the Great Capital channel, and you can watch a webinar replay. We've got a deal breakdown. We've got due diligence, rehab over, all kinds of cool content, just video content. If you're like, I don't want to actually do any reading, which I understand. You just can watch some videos, and then if you want to read, you can at some point you need a review. You need to at least, you need to acknowledge that you've read some things.
That's right.
We're not going to give you a quiz. Maybe we should. We gotta
like
check
it.
out boxes. All right. Well, this was great, Matt. Thanks for watching, everybody. Matt, thanks for putting together a great episode. Catch you on the next episode of The Great Report.